I can maybe mention here, as you were setting it up, that looking at Wim's educational background, I mean, we are an interdisciplinary institute, but Wim is certainly one can with envy look at all the institutions that he's been to, LSE, European University Institute, Leuven, Exeter, etc. So a very impressive range of degrees from all different places, also NYU. So really looking forward, Wim, to being here with us this lunchtime.
Thank you, Harry. So thank you everybody for joining. Much appreciated for inviting me. We have a bit of some ground to cover today, and I'll try to sort of pitch this to the best as I can, and so you can interrupt me if there's something not clear. We will talk about climate change and financial stability. We know a lot about climate change, and we hear a lot about climate change in terms of what climate change does, what it means. But taking a financial stability perspective on climate change and what it means for our economy, what it means for public finance, and what it means for the financial sector, that may be an angle that is new to many of you. And that will be the focus of today's talk. Now, before diving into the presentation, let me sort of try to unpack this. When you look at the financial stability perspective of climate change, the topic of risks is not very far. Risks come almost automatic when you talk about financial stability. And climate change and the risks on financial stability are twofold, essentially. And you can look at it from a channel perspective. So what are the risks and to which channel do they travel and affect financial stability? So that is physical risks and transition risks. So I will touch upon those two. Then we will look at how physical risks of climate change and transition risk of climate change affect economic growth, affect government's budgets, and affect the financial sector. Subsequently to that, we will actually go into what can we do about it and how can we approach this topic, and that's the policy implications followed by Q&A. So climate change matters for financial stability, and why is it? At ESM, financial stability is the core of our mandate, and that means we safeguard the financial stability of the member states and the euro area, particularly on the fiscal side. Now, why is climate change important to us? Because it's one of the long-term trends we look at that is affecting economic growth, that is affecting budgets, and that is affecting the financial sector. The other two, which we consider important, are aging and geoeconomic fragmentation. Now, the different channels of climate change risks that affect financial stability are physical risks, and I'm sure you know of these because they are in our daily life. So these are extreme weather events and natural disasters. The other one, transition risk, is reallocation and distortion from decarbonization. That essentially means that the asset value of investment changes because you're going to change your economy. And that is the result of different human behavior. We no longer buy, for instance, a combustion or fossil fuel car, but we're going to buy more electric cars. That has an impact, and that has an impact on the asset value underlying the production facilities of them. This also has to do with investment. If you invest in high fossil industries, it's likely that over time these investments will or may depreciate more than if you invest in sectors whereby the intensity of carbon is less pronounced. So those two risks, physical risks and transition risk, will come through the entire presentation. When we look at the impact of those, we actually come to understand that climate change has not just a limited impact on financial stability, but it has a large scale macroeconomic and financial stability implications and impact. And this brings me back to the mandate and why I'm here. We are here to safeguard financial stability of the euro area and its members. And that's why we look at climate change. Now, before you can start actually before you actually start to do something, before you actually start to know how you address it, you actually want to do an assessment, an analysis. And given that this is a large, complex issue, we actually decompose it. And we look at, and I mentioned it earlier, we look at three elements. We look at the impact of climate change risks, both the transition and the fiscal risks on growth, the macroeconomic impact. We look to the fiscal impact, what it means in terms of public expenditure, but also private expenditure. And we look at the financial sector and the market impact. And with financial sector, we mean banks and non-bank financial institutions, which are insurance companies, pension funds, and last but not least, the markets, capital markets. Now, we do that both in short term and we do that both in long term. But the arrows, as you can clearly see, they go in different directions. So you have feedback loops. It's not just a causal relationship that moves in one area, but it also moves back. Now, before I continue, let me try to do something interactive with you. You all have a mobile phone, or those that have a mobile phone with them. Just scan the code here and write down what you think is the greatest climate-related threat to Europe. And you get three options. And those of you that are following online, you can do that too. It should take you to a website where you can fill in three answers to that question. Just type in any word that comes to your mind. And then we see on this slide what we get. All of you. So I already see China decarbonizing fast. Which I think is very spot on. I will let this run for a while, but I can already see from the responses I get from you that migration is a key issue. I see the structure of the economy, fossil fuels for sure. China, I see. The word that is getting bigger is heat. And that maybe brings me to the next slide already. And we will keep this slide, so keep on filling your responses. And at the end, we can go back and see what sort of really comes out, what's on your mind in terms of the greatest climate-related threats to Europe. But talking about heat, climate change is a global phenomenon, and we will look at this over the next hour, particularly to Europe. But it's good to start from the global perspective. And heat relates to the global temperatures. The global temperatures, as many of you know, have been rising since the 1980s. But what is key is that for Europe, they have been rising much faster. So the issue of temperature increases relative to the global increase. Europe is rising twice as fast as the rest of the world. Now you can ask yourself, why is this? Are we producing more heat? Most is related to geography, the fact that much of the continent lies in the Arctic, and the Arctic is warming faster than other parts of the world. Now, the second element is not only heat is rising, but carbon emissions or greenhouse gas emissions from all across the world continue to increase. And we saw in one of the responses from you earlier, China decarbonizing fast. If you actually look at the composition of where greenhouse gases come from, it becomes very clear that cooperation is essential in order to address the problem. In economics, we talk about externalities. It's when you do something that impacts somebody else, you have to deal with that externality. And you cannot, everybody can move individually, but the cooperation between this pie chart clearly shows that cooperation is needed between all parts all over the globe. And so the broader the effort, the more effective climate change can be addressed individually, but also at country level and also at global level. Now, without this coordination, it becomes actually quite difficult to sort of get the results on where we want to get according to the Paris Agreement. And it's true when we talk about China, when you look at the different graphs on greenhouse gas emissions, you actually see that China is really sort of shooting up, and that we all are looking forward to the tipping point when actually top emissions are reached and that they decline again. This brings me to these two types of risk I mentioned earlier. So financial exposure to climate change, they travel through fiscal risk and transition risks. Physical risk is damage and loss caused by extreme and chronic weather events. Storms, wildfires, floods, heat waves. I don't need to explain to you that in 2023 there were serious storms in Greece, floodings in Greece, Spain last year in 2024. The issue is not that we have one-offs of those, which we can handle, but the issue is that these things will be recurrent and they will have a recurrent impact and a recurrent financial cost to address those. Transition risk is rather the loss of the declining value of investment in high carbon activities. So these two, if you want to understand the financial stability impact, those two risks are crucial to understand how that translates to the economy. So let's start with the exposure to physical risks in Europe. You see that every country in Europe is affected by physical risk. And you see that the exposure, and you can see that by looking at two indicators. One is water stress in the euro area. The other one is related to hazards, disasters. The key point is not only is everybody exposed, all countries, but there's a large variation in that exposure. So if we look at water stress, you see that Croatia is actually at the lower bound, and you see that Cyprus is at the higher bound. And in between, you see lots of variation between the two countries. But everybody, one way or another, in the EU is affected. When you look at hazards, which are exposure to disasters, essentially, you also see that the exposure is there for every country. But you also see that the lack of coping capacity is not equally distributed either. So you see variation both in terms of extreme events and how they affect countries, but also how countries can deal with that. So that's the physical part. Exposure to transition risk, and we talked about it earlier with Teresa. The interesting bit is when you say, how does transition risk affect our economy? Actually, 4 sectors count for 2/3 of transition risks. Those are electricity and gas, household, buildings, as it were, and you have manufacturing, and then you have transport or agriculture in a way. Now, if you look at then the carbon emission, and you know that those sectors, the 4 biggest ones, count for 2/3, and you then look at carbon emission and intensity in the decline in Europe, you know that also the transition risk is affecting those 4 sectors most. Because as carbon intensity decreases, the emissions by sector will go down as well, and hence they will be affected more. So the more carbon intensive sectors will be affected more as emissions go down. And that's a transition risk. And in that context, we talk about stranded assets, assets where investment went in, but can no longer be used or less long be used in the future. And that's the 2 graphs you see next to each other. Now, how does this affect economic growth? And this is in terms of cost, how much we produce in terms of goods and services. Now, the effects of climate change are already quite visible when we look at catastrophes. and we see large economic costs. And you can actually see that in terms of billions of euros between 1980 and so over decades, 1980 and 1989, we were about 250 billion. Between 2010 and 2020, we are at 1.7 trillion. So these costs are linearly increasing. Now, you can ask yourself, does it make sense to do something about it, or does it make sense to wait and do something about it? And that's what the right side graph shows. If we stick to decarbonization in line with the Paris Agreement, then you can actually see that the long-run GDP losses will depend on the ambition of the transition policies. Paris Agreement is more ambitious than too little, too late scenario. So under the Paris Agreement, we see that there will be losses, but those losses will be maximum in 2100 or in 2060 between -4 and -6. But if we look at too little, too late scenario, we actually see that both the transition costs and the climate damages go in the direction of -10% of GDP. These estimates are actually quite clear in terms of what it means. So the key message is from this slide that it's less expensive and it pays off well in terms of risk, cost, and confidence to orderly and timely mitigate climate change. Better to do something about it earlier than to wait for it later, because the cost will just increase. Let's see. This is exactly the same message that we show on this slide. So the macroeconomic cost of no or delayed action. And here we have actually three scenarios. So there's a network called the NGFS, which does a lot of work in terms of modeling on financial economic impact. And the NGFS has 7 scenarios, of which you see 3 here. One is current policies, one is delayed transition, and one is the net zero 2050. So under the net zero 2050, and this is what we are striving for in the European Union, all countries have signed up to the Paris Agreement, and that's the commitment to come to net zero in 2050. Under the net zero scenario 2050, the impact of climate change risks is -5% of GDP. And that's an orderly scenario. In other words, we lay out where we want to go, we have a commitment on how we take that journey and where we tend to end up. Now, if we go to a delayed transition scenario, that means no additional climate policies implemented until 2030. Then much stronger policies will be needed later. And you actually see delayed transition, you see that the economic impact actually becomes much larger by 2050. If you then take current policies, and current policies assumes that with the current policies we have in place, we don't do anything else, just our current policies, that we implement those only, then under that scenario, the estimation is the yellow line, it goes even over. We have different estimates from Kahn. We have also estimates from Godel. There's lots of uncertainty around these estimates, but these estimates essentially provide a framework of thinking about what does it mean in terms of different pathways to mitigation climate change. It's the possible futures out there, sticking to them. Now, the impact of climate change risks on economic growth also travels via different transmission channels. We mentioned it earlier. So here you see that it affects private consumption, what we consume. It affects public investment, what we invest, public consumption, net exports, and private investment. Now we see that private consumption is affected most compared to public consumption. So The transmission channels come via lower productivity and a higher level and more volatile food and energy prices, which we've also already witnessed. And this also has an impact on real wages and consumption. We also see that uncertainty around extreme weather events has an impact on investment. It weakens investment. When you're in a coastal town and you know that your coastal village is subject to increasing flooding, will you invest in a new shop or will you sort of decide to do it elsewhere? That's sort of a very tangible example of uncertainty around investment. So we talked about economic growth. All scenarios show that the impact will materialize in any way. Now let's go and look at how government budgets are affected. So public budgets, they help absorbing damage costs. I think in this country, Belgium, there was a serious flooding in the south of the country a few years ago, whereby a village was seriously affected. The government stepped in and really helped absorbing the damage cost. Now, if we sort of broaden this up beyond the local or the country level, we have two ways of inferring the related costs. So we can do this directly from recorded losses, or we can do this indirectly from weather data. When we do it for one shock, indirectly, the impact is between 0.1 and 0.2% of GDP. When we do this directly from weather data, these numbers double. So the yellow is the Euro average, the blue diamond is the median. And you see that actually for storms and floods, this is much higher than it is for droughts, wildfires, and heat waves. The same when we do directly or indirectly. The key here to understand that this is an impact of one shock. But we will not have just one shock. We will have recurrent shocks. And that's where the addition of the costs of dealing with this will increase. Now, this means that there are increasing budgetary pressures to mitigate the transition risks as well. So the other one was adaptation, coping with climate change. The transition risk is how to deal with the mitigation of it. So also reducing your emissions. This is self-assessed. So when the member states were asked, what's your self-assessment to mitigate public and private, to mitigate climate change, and what is needed in terms of public and private investment? And you see that member states take a different approach to how they look at the self-assessed mitigation, with Portugal having the highest numbers and Finland having the lowest numbers. Now, if you take that to what is public extra investment by country to decarbonize your economy into account, you actually see this variation again. As we go along, both the self-assessment and the extra investment needs will become more granular, and we will start to understand better on what is needed. One thing that you can clearly see from these numbers is that huge investments are needed. That brings me to the third pillar of the analysis, which is how is the financial sector affected? So let me sort of take this one step back to financial sector impact. If you take the floods from Slovenia and Greece in 2023, and if you take the floods in Spain, they are reminders of devastating impact. Now, not only are these ones off, but they are regular. So regularly, we will have disasters. The financial sector channels, whereby these disasters impact the financial sector, are banks' loan books, portfolios, so bank lends. When it lends in those portfolios, you have lots of loans with collateral, which is the counterpart of the loan, which are affected. So let's assume you do a mortgage, a bank does a mortgage, a house is being built, a house is destroyed. How is the bank then affected by a loan that is no longer being repaid? who steps in. So the loan book is a very important one. And the second one is insurance. And we see actually from analysis, we see that the insurance sector, insurance coverage against natural disasters remains low. And it depends on the legislation that is prevalent in many countries as well. Only 30% of economic losses from weather and climate-related events are insured. That means 2/3 is uninsured. That leaves a sizable gap. Now, just let's think about the floods recently we saw in Spain. Anybody who has an insurance on his house or on his factory or on its firm, and the firm is no longer able to produce, or people lose their house, that is uninsured, not quite clear who steps in to provide the funding to sort of get going again. Now, if it is insured and you have concentration risks in an insurance sector, one insurance company that, for instance, was in the local town really exposed, what's the likelihood of this insurance company being able to cope with that? And does that insurance company have a backstop in order to ensure that it sort of can actually provide the funds back to the insurer? So it's a key issue that we see popping up everywhere. And for instance, if we look at the United States, what happened in California, there it was clear that many people did not have an insurance or were not able to get an insurance because nobody wants to insure this anymore. And we see this insurance gap, as we call it. We see this now as a key issue that is emerging on what does that mean. The third channel for banks is not just the loan book, but it's also the bonds that a bank is issuing. So a bank goes to the market, it issues corporate bonds of the bank. You can buy those as an investment. But if the loan book is exposed to climate change, what does that mean for the value of the bonds? So you get these linkages between climate change and the financial sector, and then you also have linkages within the financial sector between insurance and banks, because sometimes banks do not only provide loans, but they also have links with insurers. So let's look a little bit on what that means in terms of how that translates in the financial sector. So the carbon footprint of bank loans, again, we look at countries, we see that this varies. So if you give a loan to a company that is carbon intensive and your portfolio is concentrated in carbon intensive loans, you're more exposed to climate change than when you actually spread. We know that some banks actually no longer provide loans to carbon intensive sectors because they actually want to offload carbon intensive exposures. So we see here Slovenia on the left, we see Cyprus here completely on the right, and lots of variation in between. Now, if we look at insurance, bonds, and equity investments, what I talked about earlier, you actually see that, for instance, for Ireland and Luxembourg, this is very high. For Germany and Lithuania, this is a lot lower. Now, so far on this side, 9% at the highest level in Ireland is still manageable.
What's a climate exposed industry? Cover climate exposed industry.
For instance, if you have an electricity company that uses oil to generate electricity, then you're rather climate exposed.
Okay, so it's about the oil.
So what does this now mean for policy implications? So how can we go about this? I think this is a very interesting way of looking at it. So as I explained earlier, climate change has an impact on economic growth, and an orderly transition is crucial to contain the climate-related economic losses in most Euro area countries. We actually plotted the impact on countries along two different scenarios. One, we see NGFS scenario net zero, which is Paris aligned, and we have an NGFS scenario current policies. So if you look on your y-axis, the NGFS scenario net zero gives us a possible future whereby the impact, let's say, on France is around -6% in terms of deviation to the baseline, whereby no climate change takes place. If we now go to the scenario current policies, whereby we don't do anything on top of where we are now, that number increases significantly for France. And you can plot that for all countries. So it becomes very clear that an orderly transition is less expensive, less costly than saying we don't do anything now, we wait until later and we will deal with it then. And I think this is exactly what in Europe the policy has been so far. Now, member states and the EU contribute to this. So what can we do on top of what we are already doing? And you must have heard about the Draghi report. It's recommended, my world is recommended reading. One of the key things that he talks about is the single market. So the single market, improving the single market, lowering barriers between the EU 27 can actually generate quite a lot of additional growth for the EU, and that can actually help a lot. So it creates incentives for the transition. We will have better carbon pricing, and particularly on financing. As you generate more growth, green growth, your financing becomes easier. Technological progress, again, using the single market by building bigger research centers with higher investment generates a positive spillover. Insurance and risk sharing, I mentioned this earlier. So at the moment we have 27 capital markets in large. If you would build a capital market without barriers in the EU, you would be able to invest across the EU into a green project on the other side that matters, which is now much more difficult than it could be. NGU is a very clear example whereby actually we brought together lots of resources in the European Union. We redistributed those, and 30% of the envelope is spent on green projects. It also caused the EU to issue green bonds, which is project-related. It's not project-related finance, but you know that if you buy that bond, that it's linked to a green project, which is kind of an innovation at the time when NGU was set up. Economies of scale, I think the energy market in Europe, it's a no-brainer that if you integrate the energy market and you bring energy from where there's an abundance of energy at a certain point of the day to where there is very little, and that you make that communicate, that is really sort of economies of scale. CBAM, it's not the idea we have carbon leakage. That if we really work in Europe in terms of making sure that goods are produced less carbon intensive, that this production facilities moves outside the EU to locations where you don't have this regulation, and then you import those goods again. CBAM tries to find a solution to the cost related to that. And then policy coordination. As I mentioned earlier, what can we do? Coordinating policies across member states. It's a positive sum game, but not just across member states, but also on a global scale. The member states, investment, mitigation, and adaptation. Mitigation, we have a very good idea. What is really changing rapidly is adaptation. The cost of adjusting to climate change, we get a much better picture. And the latest scenarios from the NGFS that sort of give us an idea on where climate change is going in terms of adaptation included now a damage function. And the damage function have really sort of significantly increased the cost. Dealing with stranded assets, I mentioned before. How do you go about this? The idea is not that you sort of discard the stranded asset, but the idea is that you really gradually bring those stranded assets and change them into something that is more greener. It's not a 0 and a 1. It's really sort of making a trajectory. And then incentives for tax innovation to help technological innovation. When you start reading about it, there are so many innovations possible for the green transition. We just have to sort of provide investment and bring them online. Now, let's say something about the investment needs. So we try to sort of not just look at 2015, what the costs are, but let's try to sort of bring this back to what is ongoing now, on what we need and how much we need. And this is sort of an analysis whereby we look at what is required and what we have already online, the funds that we have foreseen, and what is the gap between the two. So totally, the additional annual investment to meet the climate targets by 2030, that's within 5 years, are estimated between 350 and 620 billion. That's about 2.6 and 4.6% of GDP on an annual basis. The Green Deal provides 131 billion, NGEU provides 44.6. That leaves a gap in a range, and it's a large range because there's lots of uncertainty around this, of 174 and 444 billion. Now, the public sector, with the debt levels we see throughout Europe, which have become higher, is not able to pay for all of it. So the private sector need to chip in. And we just did a calculation whereby we said for every euro that the state pays, the private sector crowds in another 4. That means that the gap, if we come to an end, the gap is between 139 billion to 355 billion for climate change mitigation. Now, these sound really big numbers. But if you take a step back and you look at the capital markets and what they generate in the European Union, which is the private sector, as it were, and we tweaked around a little bit. We were thinking of what additional flow do you need in all the financial instruments that you have, which are about five. Do you need a lot? And actually, if you have a few percentages here and there, whereby you generate additional flows into green investments, you actually get there pretty fast. It is not sort of insurmountable. It's something that is achievable and is doable. You just want to work with the capital markets and how you can actually lower cost for capital to flow in to get there. And this is ongoing with the Investment and Savings Union. Now, these estimates are uncertain. There are lots of estimates out there. The Draghi report talks about 800 billion. The Commission made an estimate of 1 trillion. But these are all large numbers, but it means that it is actually possible. We just need to get the momentum in order to get there. And with the Savings and Investment Union, which is a new program that the Commission has put forward, there is lots of work on. So again, financing of the green transition will mainly have to come from private funding. Public sector can do a little bit, but the heavy lifting will have to come from private funding. Public funding cannot do it on its own. Let me say a little bit about green bond issuance. This is an example whereby we actually see that it helps and it takes off. So in 2000, green bonds are bonds that are linked when you buy a bond, a traditional plain vanilla bond, it can be linked to any type of investment. A green bond is linked to a green project. And you can actually clearly see where the investment goes from beginning up to the end. the criteria are very stringent. In 2014, we were close to 0.5%. By 2023, we were actually, for government bonds, green bonds, and for corporate bonds, we were close to 8% of the total market in bonds. On a global scale, this reached the 1 trillion. So gradually, as green bonds are being issued, you actually see that there is an appetite for investors to go into these. And these are clearly earmarked for mitigation and adaptation. So it's just one example whereby this can work. Sum up. So climate change related risks impact financial stability in the euro area and its member states. These risks have an impact for our mandates to safeguard financial stability. That's why we look at it. From a financial stability perspective, an orderly transition is crucial so that we plan ahead and that we know how to go about it. Significant physical and transition risk underline the ambitious mitigation objectives that we have. All this requires lots of investment. The private sector would need to do the heavy lifting. And I went too fast for one. The last one is, and while improving sustainable finance at bank and bank level info on climate risk, we can benefit from an accelerator. And with that, I know that this was a lot to digest. And that it may be a bit complicated, but it lays out a way to think about financing climate change, mitigation, and adaptation. Thank you very much. Questions, and they don't have to be about this.
I have 3 questions. Thanks for this fantastic presentation, super interesting. I was wondering, you mentioned some asymmetries at the beginning also with regard to coordination problems. But then if you look at the asymmetries within the EU, but also with China, etc., the question is, of course, how can you tell other countries to stop economic development? While in the EU and core countries, we are fully developed and we do not need those heavy CO2 emission manufacturing anymore. So how does that play into this coordination problem and what can be done about this? And then also I found it super interesting, all the models that you presented. And I was wondering, what is the politics behind those models? Because there's a lot of uncertainty that needs to be dealt with in those models. So is there a specific type of model that you are considering, or is there specific institutions that you work together to develop those models? Or that, because there's unlimited amount of models possible, I can imagine. And also what I was wondering, that's the third question. The EU is of course very good at talking the talk and this effect, etc. It's also good at walking the walk. And specifically, I was wondering with the Capital Markets Union, which I guess you indicated, can we be sure that this time the private capital markets will actually solve the problem? Because I remember in 2007, the capital market was the core of the problem that has become the great financial crisis. So can we be sure that this time private investors actually going to get it right? And is there maybe also potentially a role of the central bank with possible credit allocation or development banks? Yes, thanks a lot. And I'm sorry, I have to leave right after because I need to teach. But thanks a lot for the fantastic presentation.
So thank you very much. So I'll deal with your questions first. So coordination at a global scale. I think the mechanism that we have in place is COP, where you really sort of have coordination taking place. Are these the ambitions matched with the agreements at the COP level? It depends. The results have been uneven. There's disappointment at some outcome of COPs, but there also have been very successful ones. A key issue is redistribution and how you deal with economies that you want to become less carbon intensive, and support for that, financial support, whereby some economies are saying, please support us for not for actually greening our economy. And there has been disappointments. At this point, on a multilateral basis, globally, I think COP is the key vehicle. And we know all about the disappointments, but also about the successes from time to time from COP and the ambitions there. I do not see, apart from the global efforts at the World Bank, the International Monetary Funds, and then the regional development banks, where also sort of support comes, I do not see another vehicle for coordination. I also think in this context, coordination is something that has been mentioned time and time again, because enforcement, I don't think, is the way to go. Becomes very difficult. So we keep on looking forward to each and every COP and the ambitions it's trying to make. Uncertainty scenarios, I really strongly recommend you to read the NGFS scenarios. The NGFS scenarios in Europe, and it's the Banque de France and the European Central Bank that develop scenarios that lay out possible future. They have 7 scenarios and models underlying. There are many good economists that work on that. You have very technical documents on them, but you have very accessible ones on what they mean, and they're very useful. Why? Because each scenario is internally consistent. It really lays out a possible future if you do a number of things according to the assumptions. These scenarios were developed already quite a number of years ago, and they have gotten better over time. And everybody's using those scenarios in order to judge impact. So by using those, you have a baseline. The baseline is we are thinking climate change doesn't exist. What would economic growth look like? And then you build models that model different pathways relative to your baseline, and you see what the deviation of that is. And I've shown you 3 out of 7. It's actually quite interesting. So NGFS, please go have a look. Super useful and gives you a very good idea on how to look at climate change in terms of financial stability. You talking the talk and walking the walk. I'm an optimist on that one. A couple of years ago, when we were looking at EU policy on climate change, both particularly in terms of mitigation, I think it's a sound policy. It's complex, but it's a sound policy that really lays out the future depending on the commitments and actually relates to the commitment Europe made to the Paris Agreement. If you look at that, and if you look at, in terms of mitigation, at the trajectory of greenhouse gas emissions and where this is going, and I do like this, actually, the needle is moving downwards. Is it moving downwards fast enough? Not necessarily where we're supposed to be, but we're getting there. If you look at the needle in the United States, it actually, with IRA, it's also slightly declining. If you look at the needle in terms of policy in China, it's actually shooting up. But I mentioned earlier, we all expect that there will be a tipping point and then that it would sharply decline. But in terms of walking the walk, talking the talk, I think the policy is sound. Now, we talk about trajectories, and these trajectories are in greenhouse gas emission declines in the European Union. Now, do we do the same thing on capital markets? And now, with a different terminology, it's called the Savings and Investment Unit. The trajectories are not similar, that's for sure. There is so much hanging on this, and the ambition is so high that this project needs to work. Because it's the key vehicle that it's actually going to finance, is expected to finance the key transitions that are out there. And one is climate change, the other is aging for that, and then the third one is geoeconomic fragmentation. And if we do that in the context of the internal market, the IMF has a very nice study on this. It's actually well possible. But now let's see how this develops. Indeed, you're right. In terms of past trajectory, maybe this time around it's going to be different. And then you mentioned the central bank. financing, not entirely clear. The central bank does lots of research on this, is really a driving force, the European Central Bank and central banks in general, driving force in mapping this out, in mapping financial stability perspectives. The central bank is also engaged in buying green bonds. Is there additional tools out there at this stage? I don't think so. Is there an additional role for the central bank at this stage? I don't think so. But I don't want to comment on central bank policy. Come on.
As the non-economist, let's see. And thanks, Wim. I had a couple of questions, and I'm going to invite you to think out of the box, maybe.
Oh.
The first question is not related to the presentation, but related to something you said right at the beginning with the mega trends. You mentioned climate, aging, and geoeconomic fragmentation. Can you explain why those have been chosen as the three mega trends, not, for example, digital, which is also revolutionary in a sense? And that was one question. Another one, the scenarios are really useful, but they always talk in terms of GDP. And I know you do financial stability, so you have to talk about GDP. But beyond GDP, I was wondering, okay, how many people will actually die in this scenario? Or, you know, how will the institutions actually be affected? What's the capacity of the institutions to deal with these shocks? You showed one where obviously Belgium is very bad at coping. But those kinds of scenarios, they might help policymakers actually understand, you know, that this is, you know, the economy is important, but it's also the very structure of their institutions that's important. In relation to that comment, more as a question, do you actually, when you talk about policy coordination, do you actually look at things like institutional innovation across different countries? For example, the Netherlands is built on water, and it has very good multi-stakeholder institutions for actually governing how water is managed in its country. Is that, does the ESM, you know, in your policy circles, does that actually get circulated around these institutional innovations? And then finally, one question. I'm always, and this is a comment, but you can comment on my comment. I'm always concerned when we see things like, oh, China's producing a lot of CO2. Yes, but a lot of the products we buy in Europe, you know, are actually built in China for that reason. So wouldn't it be interesting also to look at not, oh, look, Europe's only 8% of CO2 production, right? But actually look at what Europe is consuming in terms of CO2. That might actually present a completely different story.
Well, the question.
No, yeah, lots of things for you to think about. You don't have to respond to it.
So why those three trends out of the universe of trends? Because you mentioned digital. Yes, digital will have a big impact on how our economy works. It will have a positive impact on how our economy works. We assume that the digitalization of the economies will increase productivity. The digitalization will have a financial stability impact. Yes, it may have a financial stability impact, but that financial stability impact will travel via different routes, like cybersecurity or AI and what that means. But does that have a negative impact immediately in terms of economic growth, immediately in terms of budgets? There are investment needs, and NGEU caters with 30% digital on that. But in terms of really sort of thinking out of the box of a severe shock coming from digitalization, I do not see it immediately unless it comes via cybersecurity. So that's one of the considerations around digital. For climate, clearly long-term trend, which we see globally. Aging, clearly long-term trend that we see globally. Japan is a little bit ahead of Europe. Europe comes later, but this is coming fast forward at us. And if we look at the aging impact comes not just in terms of the structure of our economy, but it particularly touches also budgets and how you deal with budgets in order to guarantee the current generation to have provisions that when they retire. But it also means the impact is also on productivity. Productivity tends to be lower. That's what most studies indicate. So there we see an impact on the three elements: growth, financial sector, and on budgets. Geoeconomic fragmentation is the last one. And that's sort of the most salient one at this point, because it has been there simmering a bit, and now it has accelerated pretty fast. All models we see show a significant downside impact. So that's the reason we looked at those three criteria: growth, financial sector, and budgets, to sort of do the selection of the megatrend. GDP, you're absolutely right. The focus of what we do is definitely on GDP. Societal impact and human life loss. I mean, when you look at the numbers for floods and the human suffering, it is there. It's not exactly something we can put down in numbers, but we definitely acknowledge that climate change and the human loss associated with it is incredibly important. That's sort of the number one. We are in the business of quantifying things and trying to capture numbers, but it's not that we disregard it, and it's not that we don't find it important. Just within the framework, this is not sort of the way the mandate works. But we are very much aware about it, and also the social side, which is something you really need to take into account, particularly in terms of policy response. And I think those elements are both at the member state level and are also at the European level when we talk about the social transition, the just transition. The just transition in the NGU package is indeed to sort of bring people along in that transition that takes place to mitigate climate change. Policy coordination and institutional innovation is a very good point. We call them the waterkeringsmuren. It's the walls that built the Dutch to sort of fight the sea. This was an incredible social project taking place, I think 40, 50 years ago, whereby the entire society was engaged with that. I think that somebody said it at one of the conferences, local and regional level are super important in order to do climate mitigation. So these innovations can certainly be useful. The framework within which the spillovers can take place can be the EU, but it can also be at a global. China, sure, we showed the absolute numbers. If you turn that into GDP per capita, yes, you see a totally different way of looking at it. And one of the things, if you look at India, 1 billion people, on a GDP per capita, so India is still not emitting, and the emission levels are flat. So you're absolutely right. We buy in Europe, we buy lots of products, but we also export lots of products. It's not about deindustrialization, but it's about sort of doing the same or similar things with a greener industry, right? That's what we expect from China too. One of the interesting discussions we had on this is China is now producing solar panels and electric vehicles at much cheaper costs. What should we do in Europe? And some people say this is a public good. Should we take that in and just use it and focus on innovative green industries for the future? I think it's a very interesting topic to discuss, and maybe there are ways to deal about this. I think the key point here is innovation. What it means to bring your industries along the trajectory and find the right balance between innovating your green industries and sort of bringing online what is possible while actually using what is already out there. So I think also the consumer is adjusting to its preferences in that sense. And I heard the other day that, for instance, in this country now, out of each 3 cars that are sold, 1 is an electric vehicle, 2 are combustion engines. So maybe also consumer preferences are changing. Yeah, a very good point. And on China, on a per capita level, much lower. And we hope to see peak time soon.
You can go ahead.
Sure.
Yeah.
Just more detail on what you just said, because it's very interesting for me how you frame it, this, drive to innovate versus using what's already there. Because in my research, how I frame it is between competitiveness agenda of the EU and the need for global cooperation, right? You can also read it that way. And for, a global green transition, what we would need is cooperation and moving away from this competitiveness mindset where we need to develop our industry and maybe using more what's already there. And you mentioned the Draghi report, which is all about competitiveness. So for me, it really doesn't come together as this something that is tackled, or the competitiveness is the baseline where we start from.
I mean, you can do one way to look at it. So there has been so when Europe and the United States went to China, they did investment, but there was also technology transfer in the investment, and it was a partnership between the two, and there was cooperation. Maybe in those industries where China has progressed faster. I think that's very clear in building solar panels, and I think it's also very clear in electric vehicles. We can turn that around. We get partnerships in Europe where there is knowledge transfer in a partnership and cooperation.
And do you see that happening? Because this is not the discourse that
No.
I cannot. It's quite the opposite. But yeah, it would be ideal.
I mean, one of the keys, so the innovation elements is one of the elements for consideration, right? In sort of changing the structure of your economy. I think it's a key element on how you deal with this trend. And where does it matter that you actually use advantages of other countries and where not? And I think innovation is sort of a key element whereby you say, look, maybe in certain industries it becomes very difficult for us, for the European Union to catch up. And maybe we can go into partnership whereby access to the internal market and knowledge transfers sort of go hand in hand and you create a partnership. I think we've seen that before. And I don't see a reason why this could not happen. Now, I think that we are not in the business of sort of industrial policy, but this is one of the ways to go about it. Economists, in any case, discuss deeply about it, and they say, well, this does not make sense, or this does make sense. We know that tariffs are not exactly ideally placed in certain circumstances to deal with this. So I do see a role for cooperation, while at the same time also innovate. And that cooperation makes you then competitive, right? So it's a win-win.
It's kind of, you mentioned that GDP growth is obviously like paramount. That more general question: is there ever any discussion of kind of like trying to mitigate the negative consequences of like a reduced growth rate, or kind of like not to put forward a degrowth or like post-growth argument, but just it seems that's as an alternative, like just investigating that more like in the existing system.
So the argument, if I understand it well, is just, and it's a valid, it's a point. The argument is if we grow less, we would emit less.
Yes, and then kind of looking at how do we deal with the current negative like consequences that arise with this like reduced growth at the moment.
If I would turn that around, I would say if you grow less, do you also then develop good greener technologies?
Right, but then if there's not a need for these greener technologies, or like a reduced need for the technology so immediately, then like you have more time to develop. Like there's a lot of emphasis on like technology development kind of in this argument. So I think, I don't know, just like kind of more of a, just like a general perspective in the ESM and like at the discussions.
So usually in the economic and financial sector, the element is, you need sufficient growth. If you don't have sufficient growth, there are all sorts of issues that emerge around financial stability in the economy. So that's sort of the baseline. But there is a sense at the same time that you can green your economy, and that will generate growth on its own.
There's no discussion of like a reduced growth and then looking at the negative, like.
But the figures show that there will be reduced growth.
Full stop. So full stop. So the figures show that because of climate change risks, both adaptation and transition, your growth will go down. Effects will be there. But to sort of do that intentionally, reduce intentionally your growth, no, that's not a discussion that is ongoing.
Even in a more differentiated way, saying we would grow in more green technologies or social elements on environmental matters more specifically, but then much less on carbon intensive industry and polluting industries, etc.
But that's quite clear what you say. So that's quite clear.
That kind of differentiation.
Sure. There's a clear sense that there's a direction of travel, and the direction of travel follows mitigation, which means that you reduce your carbon footprint. That's for sure. And we see that also happening. We see that in the numbers, both on greenhouse gas emissions, and we see that on a number of metrics. And the idea is that this will intensify over time. In a way, this will become more difficult, and it will become also more costly. Because the last bits of the transition to net zero will be the most difficult ones. And the technology we need for that to get there is technology which we know exists, but needs to be brought online now and requires scale. So this differentiation is there. I mean, particularly in the main sectors that we've seen, we actually know for households what is needed. We know for energy transition, we know what is needed, but we need scale to develop those things. It's not that something totally new has to be invented, but we need to create scale, meaning much higher production levels and much more higher provision levels in order to get there. And that's sort of the idea, but the differentiation is definitely there. I think there's also a general sense that high carbon intensive industries, how do you think about your portfolios over 25 years in that sense? And how do you think about stranded assets and what that means within 25 or 30 years? How to deal with that? And it's, as I mentioned earlier, the differentiation is not, it's not a dichotomous variable whereby you say we switch it on and we switch it off, whereby it's completely black or it's completely green. Much of it will be sitting in between, will be a little bit gray, will be a little bit greener. And it's key to sort of bring that along on the green trajectory. And the social transition is essentially people moving between sectors, right? Carbon intensive sectors to sectors that are less carbon intensive. Reskilling and much of interaction with age.
Let's give kind of a follow-up. You place great emphasis on the role of the private sector in coughing up 355 billion euro.
It's not 355. It's a little different.
Yeah. Okay, and I understand that with a bit of tweaking that can be done quite quickly, right? But it's still I'm wondering, normally in situations like this, the private sector goes to the government and says, the climate crisis, we need to reorganize our we need to reorganize our markets, we need to restructure, and can we have some subsidies, please, to help us? This time, it's actually governments going to the private sector and saying, oh, the climate crisis, we need you to reorganize yourself, please. Wouldn't it just be easier to tax them? And that's a non-economist asking an economist. Couldn't you just say 5% tax for the next 20 years? Sorry.
No. So there are two elements here. So we've seen actually over the last couple of years, let's start first on what is possible for the public sector. We had a serious set of shocks over the last decade.
Yeah.
We're actually quite in an extraordinary situation. So we had the great financial crisis in 2010. Then from the great financial crisis, we got into the COVID crisis. And after the COVID crisis, we got into the energy crisis. If you sort of add all that up, and now we are in a, not yet in a crisis, but geo-economic fragmentation is on the rise. So we had actually a set of shocks that hit the public sector, particularly governments. And if you look at debt levels throughout the world, but also in Europe, debt levels, because the responses to those shocks have been taken, debt levels have gone up. That means that more states are more indebted than they used to be, which means there's a limitation on how much the state can do. Usually, if your fiscal space, as we call it, narrows, you really need to think about how can we deal with this. I think in most development banks and most multilateral banks, where you have a public-private partnership, sort of the assumption that we had here of crowding in private investments by taking on the risks on the public side is a quite to go model. Yeah, so in a way, with limited space, fiscal space on the public sector side, you put up €1 and you ask for the private sector to come in. Many multilateral banks actually take on the risk. I think take a big chunk of the risk. Take the European Investment Bank. It's very active in the private sector across the EU, has a huge balance sheet, but usually when it invests, it not only puts its creditworthiness behind the project, but it also takes on in risky parts of the investment, which actually brings a hesitating private partner along, which says, if you do it with your balance sheet and with your creditworthiness, I'm happy to go along because you also bring know-how and experience. And that's sort of a model that can work. And when you look at the budgets that NGEU has brought forward, and it's still running for 2 years, there's lots of public-private cooperation going on between the two. And this is also a way to go when you look at the fiscal space that member states have. So I don't know whether that'll answer your question, but that's sort of, I don't think it's possible, if we look at the numbers involved, that it's possible with that fiscal space we have, that actually member states can pick up the bill. Full bill.
It shows how naive my question was.
It's not naive, but it's sort of a way that usually multilateral development banks work, and it's also a way that the European Investment Bank works, and to a large degree also the EU budget.
It's just based on what I see in the digital field right now. So the European Commission is launching, the Digital Networks Act. It's supposed to come out at the end of this year. And already the private sector is knocking on the door of the Commission, saying this will cost money, we need money to lay out this digital infrastructure. When the Commission's discourse is always the private sector should pay. Private sector saying, yeah, we'll pay if you give us the money to pay for these things. That's where this came from, and that's why I thought, is that how it works in this field as well? But obviously these are the banks that take on the risk, which makes it clearer.
This is an assumption that we made is 1 versus 4, so 20% versus 80%. I mean, you can be range, right? You can play around with that. But for the challenges coming at us, and if you take the Draghi report, the 800 billion that most economists agree on an annual basis, we need the private sector to come on board. It's not possible for the public sector to do that, particularly not with all the challenges that are ahead of us.
No, but the other response is that the public sector just taxes the private sector. An extra 10% climate. You know, we in Belgium we pay a green fee on our electricity bill. 1%.
There's also at the European level the ETS.
Yeah.
Actually, I'll show you. So this is quite interesting. So this is a carbon tax and a carbon exchange map of the globe. And I think Europe, if you look at Europe, so ETS and carbon tax implemented, Europe is the most advanced. That's the orange. If you then look at ETS implemented, you see it not in the United States as a whole, but you see it in various states. And you also see it in Australia. Then you see carbon tax being implemented in Colombia, parts of Latin America and Africa, and then under consideration. But in most, what is positive about this is that there's an idea that you actually need to offset carbon emissions somehow. And that can happen through an exchange system, or it can happen through taxation. So it's not that we don't do it. The only thing that you can think about is whether the pricing is developing as it should. So how much are we pricing a ton of carbon emission today, and where is this price going? As if we stick to the climate accord of Paris, a ton of carbon emissions will become more expensive as we go along. And so hence, ETS and the carbon tax will generate much more funds. But at some point, also your emissions will decline. And so your income from the ETS and the carbon tax will go down as well. And that's the last bit that we talked about that will be very difficult. But sort of, if you look at the map, many parts of the world have some form already online. And usually they look at Europe as an example, as the most comprehensive trading scheme.
I think we're reaching the time, and we have exhausted you probably with all the questions. One last question maybe, or maybe I think we're good. Thank you very much.
Most welcome. Let's go to the word clouds and see what eventually.
Yes, let's go back. International trade.
It's actually quite broad, huh? Everything that you deem related to climate change. Migration is definitely there, demographic changes, disasters.
Anything you think is missing or you were expecting to see that you don't see?
It's what negotiationism is. Is that negative or is that negotiating? Or is it negationism? Is it just my eyes? Oh, it's my eyes. I thought you said negotiatism.
Negationism, I think it actually means that you no longer believe in climate change mitigation. And you say, are we sort of ostrich policy whereby you stick your head in the ground? There's lots of debate on whether we are still in the 1.5 or whether we are in the 2 degrees warming at this point. What that means and whether it's an average or, I mean, I mentioned that for 2024, we surpassed 1.5 for that year. Does not necessarily mean that this will now be a recurrent phenomenon. maybe it still goes down. I mean, it's clearly to look at it on a 10-year basis, but we see high temperatures, that's for sure. And there's lots of debate on whether we passed it or not. Maybe that's what it means.
One last response in this last minute. 29. Thank you so much.
Welcome. Thank you very much.